when the market's rising, people think the risk is not being in it, right? And so then they pile in buying all sorts of crap and paying, overpaying for B and C grade properties. When the market turns, though, they look at the risk and think, oh, the risk is paying too much, right? The risk isn't paying too much. It's still buying the wrong property, or in this case, in a falling market, it's not buying the right property. That's actually your risk. So it doesn't come down to paying too much. It's around, basically understanding the market, understanding, like you say, looking at each individual property for its risk, an area for its risk, the property for its risk, and also your own lifestyle and what's important to you and what you need, and getting all of those elements sort of right in the right balance. So on a micro level, on a personal level, that's what a lot of people do when the market turns. They go, right, that's it. I'm going to sit on my hands and wait for prices to fall. But they're then thinking, it's like they think micro in a rising market when they really need to think macro. And I think they do the reverse in a falling market. They need to continue thinking micro.
Yeah, I agree. I think the getting a quality asset is actually potentially going to get harder. Because, if there is any sort of downturn and prices are starting to fall, the medians are falling, even in quality suburbs, medians will fall. It doesn't mean that the best properties are falling. And, sellers will start saying, well, the market's not that great at the moment. I'm just going to sit on my hands. That's what the 2018-19, that period for clients was really tough. We had lots of clients pre-approved. We bang home quality every day to them and try to convince them not to buy a lot of properties. And, tell them things they don't really want to hear, don't validate it if we don't think it's a great asset. And, at that point in time, it was just, there's not much out there. And then they'd finally find one and then they'd go to it and there'd be 40 people at the auction. And that's the same thing that's going to happen. Yeah, it's the same that's going to happen, I think, in the next couple of years. The stuff that's not is compromised is going to sit on the market. We're already seeing that. The good stuff's going to get all the buyers and it's going to be harder to buy those because everyone's going to have a crack at that and it's still going to go for a decent price. I also think that families aren't going to get scared off by rates in the threes. A lot of the people are going in there with big deposits in the upgraded market. And, there's a portion of society that's doing very well financially. Inflation is also linked to wage increases and those wage increases aren't even. And some jobs and professions are getting huge wage increases. And some people within those are getting big bumps because they're going up the tree. So I think there's enough quality demand out there that are at a life stage where they need to make a property move. They can't wait 5 years because of schooling, or they don't want to. They want that lifestyle benefit, and they're not going to get scared off with rates in the threes because they've had 20-30% increases to their salary.
Well, they're probably around last time when rates were up there anyway. So I've been there. I've had it. I survived it. I've actually been there with much higher rates. So it's like a lot of people, I think, are a little bit older. They're actually thinking, well, we've had a lovely time, and a lot of people have paid down a lot of debt, or they've actually built up their buffers and their offset accounts in that time because they've enjoyed the fact that we've had such low rates. I know that's certainly been one of my focuses to take advantage of that.
Yeah, I agree. So, I think you're right. They're looking at the threes and fours and they still think that's cheap because it's only been a year or two at twos. And that when we were getting, I remember I was getting a 4-year fixed rate under 4%. We were like, wow, that's amazing. A couple of years ago, it didn't end up being amazing for clients because rates just completely crashed, as we know. But we were like, wow, that's an awesome rate, and I do think...
I know, it's all relative.
Yeah, when rates go back, I don't think it's going to stop demand at, the threes and fours. Now, if it gets up to fives and sixes, that's a different sort of journey. But if it gets to that, you'd like to think that the economy is booming, wage increases are huge, inflation's rampant, and, that's not a bad thing for property prices, to be honest, when, wage increases are pretty massive across the economy and inflation. So, yeah, I think that's the big risk is the people that have paid a lot of money last year for compromised assets. The people right now buying in areas where higher interest rates are going to hit them harder. So a lot of house and land packages, a lot of areas where there's a lot of debt with, one income or 1.5 incomes because it's a young couple with kids. Their jobs and their industries are maybe more affected, whether it's retail with consumer spending or whether it's tourism or etc. And so, incomes are already tight. There's not much wage growth. Maybe they've only got one salary. And then if expenses are going up, like petrol prices, etc., the budget's getting tight, and then their mortgage goes up and they start to feel a bit of debt stress. And, in those markets, it doesn't take much for supply to increase because there's already a lot of new supply. Plus, there's a lot of people, for example, selling. And I do think the few investors that have got, we have one today who's got 4 properties that are all in the affordability part. And surprisingly, because of low interest rates, they've gone up so much. They weren't ever great assets. They know that, but they've gone up quite a lot just because of low interest rates. And I think the danger is that people are going and buying these areas now.